I'll reiterate a happy holiday, happy New Year to everybody. I'm the CEO for the South Carolina Council on Economic Education. My name's Jim Morris, and but the real people who know what they're doing here, of course, Amanda's not running the show here, but she's technically running this whole show because she's probably the best one with the Zoom and got an awful lot of background experience. She can probably answer any questions that come up. David, being he's the classroom teacher in charge of this session. He's got some incredible background and incredible amount of knowledge. So, and of course, a lot of this, most of this is all available and recorded. So, just feel free to ask questions once we get going. Amanda, back to you.
Thank you. We still have a few people who are joining us right at 6. Again, welcome if you're joining us for the first time or for the 10th time or the 15th time. Thanks for being here tonight. As Jim said, I'm Amanda Sticklebauer and very fortunate to be able to work with SC Economics and also be a classroom teacher out at Blythewood High School teaching. My doggy keeps on yapping. Hayden, hush them. We have a new puppy in the house, so this is life. So anyways, back to the webinar. So sorry for the noise. Very fortunate to be able to teach economics and some sections of AP Human Geography, and certainly very happy to be here with you guys tonight and welcoming those South Carolina Financial Literacy Master Teachers who are here, one of which has agreed to present for us tonight. David Heimson is one of our cohort 1 initial master teachers, now achieving this gold level of certification. And David is a teacher of all things social studies, including government economics and U.S. history and 9 different electives at Anderson 5 Charter School in Anderson School District 5. But not only is David a wonderful classroom teacher, but he has many other career opportunities to share with you guys tonight, because this is not, as he'll probably tell you, his first career. And then Jim Morris is our wonderful CEO.
Oh, yeah.
I think they're trying to help me, but it's making it worse. Jim Morris is our wonderful CEO of SC Economics, and he has been with SC Economics for 7, 8, 9 years.
9 years.
It's hard. Yeah, it's hard to keep track of these now. So we have really thrived under Jim's leadership and so appreciative of all of his efforts in economics and personal finance. And he has many different experiences to share with you tonight, along with some talks on Social Security as well. So without further ado, I'll turn it over to the people who really matter tonight. I'll turn it over to David and Jim and those of you teachers who are here.
Good evening, everyone. I'm David Heimson. You can tell with my accent, I'm not from South Carolina. I'm from New Jersey. And I graduated law school in 1990. And unfortunately, there was a recession going on and I needed to find a job. And they had an ad for JDs and MBAs to get in financial services. I knew nothing really about financial services when I got in the industry. And lo and behold, I started selling life insurance in 1991, and I had a lot of success. And in a short time, I became a regional training manager with John Hancock, where I ran 16 offices in 4 states. And then I became a regional director with Indianapolis Life Insurance Company, where I ran a $67 million territory, 138 offices in 29 states, and I was responsible for about 1,200 agents on a daily basis. And I've been doing insurance since 1991, even though I've been teaching for 17 years. But my professional job in the insurance business, most of the time, was training agents how to sell life insurance. So it was not much different than being a teacher. I was just teaching life insurance agents. And when I found I got into the industry, not knowing anything, I found a product that I think is one of the greatest products inventions in, at least in world history, in terms of all the things that you could do in a financial plan and a financial literacy plan for everybody that works for everybody in a different way, because it's not a one size fits all concept. There's so many different products and there's so many different uses of life insurance that it's really untold uses, and there's a lot of tax advantages to life insurance over other products. Now, I'm going to take a step back. How many of you ever been to a party and somebody you meet says, I sell life insurance? If anybody can, right? What's the first thing we want to do when somebody tells me that they sell life insurance? I want to run the other way, all right? I want to get away from that person. And the reason is that you think that they're going to try to sell you something that you don't need, that you can't afford, and is not good for you, and you don't really want to understand that product. Well, think about TV shows and commercials that we see on TV that have shown people, even financial services companies, people not wanting to have the conversation about life insurance. They don't want to have it because it's uncomfortable, because it talks about our own mortality. People don't want to talk about death. They want to talk about living. And we never really want to see what the other side is. So what I told agents for years, you don't understand this business until you've had to pay out a death claim. You know, until you go to somebody's funeral that you provided for their family, you don't understand what selling life insurance is really about. You sell in a contract, you get paid a commission, and then it's next. That's not what financial services really is. Financial services is finding somebody who's going to sit down and listen to your needs and your wants and come up with a plan that solves those. And one of the ways that we do that is through life insurance. So who has life insurance that they purchased on their own here? Is any? Okay, so you've at least taken the step to purchase it. Now, are you familiar with what you have? Okay, that's great. Now, the nice thing is I put my money in life insurance. I don't really put my money in the financial markets because I don't like that whole up and down, you know, the market's up, the market's down. I looked at my sister's 401k, and in 2009, she lost $215,000 out of her 401k. And last year she said to me, she goes, you know, my 401k is back up to my original mark from 2009. And I said, yeah, you've lost what, 12 and a half years of possible gain from where you were, and you have to worry about the market. So what happens when you retire on a down market and your money's all in a 401k? There's other ways to do this. So let me take a step back. We're going to talk about what life insurance is. And life insurance is a contract between an insured, known as a policyholder, and an insurance company that will pay a lump sum death benefit, which is usually tax-free to the insured's beneficiaries upon their death. The insured agrees to pay premiums on a monthly, quarterly, or yearly basis, depending on the policy chosen. Now, there's different types of life insurance. There's what we call term, and there's permanent. Term is exactly what it sounds like. You buying insurance for a period of time. For most people, that is fine, especially if, let's say, they have a mortgage. They take out a 30-year mortgage, they buy a 30-year term product. Something happens to them 6 months in, their spouse gets the money, they can pay off their debt and they can pay off the house, and at least the spouse can remain in their lifestyle. Life insurance is not really meant for us to get wealthy from. It's meant to pay off our debts and to provide the lifestyle that that person would not be able to do because they're no longer earning the money. Does everybody understand my concept? So we know that term policies are the most widely available because they're cheap, they're easy to get, and almost most insurance companies provide them. But there's a problem with term life insurance. 98.9% of term policies never result in a death benefit. That means the insurance company's making all the money. And that's why they love selling term insurance, because I buy term insurance at 30 years old and I buy 30 years and I'm 60 and I can't afford term insurance at age 60, or maybe my health isn't as good as the way it was. So I rented my insurance. Who leases a car? Some people lease cars and other people buy cars. I like to own what I have. I don't like to lease a car because I'm spending all this money. I'd have to turn it back, and all I did was get use of it. It's sort of like electricity. We have to pay that bill, right? Every month to Duke Power or whoever we're paying for. But there's a problem with that. Yeah, when I need electricity, it's great, but do I get any benefit from paying on it for 40 years? It's not like Duke's going to give me a dividend and say, "Oh, that was a really good job for you paying us for 40 years, Mr. Heinzen. Here's $2,000 for being a client." They're never going to do that. What they're going to do is charge me more money. So then there's something known as permanent insurance, whole life insurance, or cash value life insurance. And cash value life means that a portion of the premiums paid fund both the mortality costs inside the insurance contract, which would pay for the death benefit, and a separate fund that accumulates cash value. Over time, using compound interest, the cash value in a given policy can be significant, and some types of cash value life insurance have additional benefits. You guys are all familiar with O.J. Simpson, right? We all know that he was sued for $32.5 million by the Goldman family. O.J. had $3.5 million in his cash value life insurance account. There's only two things that I know of that are not available to be sued for that are suit protected: your pension and your cash value in your life insurance policy. So if I'm down the road and I get cut off, I go through somebody's house, I kill somebody, somebody sues me for wrongful death, hopefully my personal liability will pay for that. But if not, they're going to come after my other assets, including your 401k. Yes.
I'm so sorry to interrupt. I've been trying to find a good time, but your screen is not being shared. Can I walk you through that?
It says you are screen sharing on mine. I'm sorry.
No, we only see your Zoom schedule.
Oh, I'm sorry.
That's okay.
Actually, I see David, so I don't know who else. It may be just the pool since the three of us are part of this. So you just may want to check a little further.
So what do I need to do, Amanda?
So go down to the bottom and do screen share again.
Okay. Let me do that. Okay. Share.
Okay.
Okay, wait, that's why. It's because I'm on this weird thing. Let me see. Does that help?
Let's see. I don't see it yet, but
Let me see. I'm trying.
we only see your Zoom tab.
Oh, that's horrible. Okay. So it says your screen sharing down at the bottom.
Okay, so unshare.
Okay, wait. Stop share. Okay, is that
There you
better
go.
now?
Okay, and if you'll go to, let me see.
I'm sorry.
No, it's fine. If you go to share screen, just make sure you have the browser selected that you're in. So mine would be Safari.
Okay, mine is probably.
Or if yours Google Chrome.
Yep.
Okay.
So where do I find that?
Okay, so go to share screen again, and when the menu pops up,
Okay.
select the tab where your presentation is.
And I do that and I get this Zoom in the back. Okay, can you see me now?
I see your screen, but it shows the Zoom. On your screen, do you see your presentation?
No.
Okay. All right, so pull your presentation up.
Oh, okay. Let me do that. I'm sorry.
It's okay. We can see what you're doing now, so you're on the right path.
Okay, let me go to my email. I think that's going to be the best place. Nope, I'll go to file. There we go. Okay, almost there.
These things can be tricky, and sometimes, I mean, a lot of us have not used these in quite a while, which has been a blessing. There we go.
Okay. Is that better?
That is better. Thank you. I'm
sorry.
to interrupt.
No, we're good. So, where was I? Okay. So what happens is when you put money into let me go back to the OJ thing. OJ was sued. The Goldmans took every bit of his assets except his pension and his $3.5 million of whole life insurance cash value. So they got his house, they got a lot of his other assets, but they could not get his assets in it. And it really is a huge difference that you are treated differently by having a life policy than almost any other financial vehicle. So when you borrow funds from a cash value life insurance policy, the IRS treats this differently than any other financial service product. Because what happens is you don't ever take your money in a life policy by a lump sum. You take it as a loan. And by taking it as a loan, you're charged interest by the insurance company. So this gives you a different tax treatment than other products because it's a non-taxable event. So think about it. You get to save all your money. You still get your beneficiaries still get paid in case you die, but you can still have what I call your cake and eat it too. You get the best of both. You can take money out, and then if you do pass, your beneficiaries still get the rest of the money, and your money's still growing tax-free into the plan. So there's a great website called bankonyourself.com, and they explain the concept really wonderfully and about creating a bank for yourself of a pool of money. Because here's how it's taxed. Think of a 401k. It's right there. They're taxed as last in, first out. It's called LIFO. And this means as your money pool gets larger, when you start taking distributions, your gain, which is fairly large, gets taxed first. Additionally, since you defer paying taxes during the earnings phase, you may feel as if being double taxed, as you may now be in a higher tax bracket than when you started to contribute. So it's kind of the double taxation of a 401k plan or a 403b for us teachers. So in a life policy, you're taxed under something known as FIFO, or first in, last out. I mean, first in, first out. That's a mistake on my PowerPoint. This is tremendously significant because when you pay premiums, there's mortality costs in every premium that you pay for your death benefit. So when you take the monies out, the IRS allows the insured to pay taxes on the monies first in. Since that's your cost basis and there's no taxable event, there's no tax due to the IRS. Just think about if you got 10% in your 401k. If you took out taxes on your gain, you get 25% on capital gains, plus any income taxes. What's your net rate of return going to be? On my life insurance, my rate of return is 6.98% this year in this economy yearly, and I have no taxable event. So at the end of the day, when I'm compounding that interest, is my net rate going to be greater than something with, by the way, it's my 6.98% is guaranteed. Is my money in my 401k or 403b guaranteed? They're not. So I don't have to look every day and see how the financial markets and go the up and down. I know my financial future is going to be taken care of. Now there's different types of whole life or guaranteed or permanent life insurance policies. Whole life are sold by the majority insurance companies, and there's usually a contractual guarantee that's required by every state department of insurance and through reinsurers of 3 to 4%. However, I'm with the company. I'm going to call the name of them. They're called Guardian of New York. They've been in business since 1860. And even during the Great Depression, they paid a dividend every year out to their policyholders. And they've never gone to their lowest contractual guarantee. As a matter of fact, I think their average rate of return since 1861 on a yearly basis is 7.8%. And that's a guaranteed amount of money. So what's the downside of whole life? You have to medically qualify. You have to go through a medical exam. And premiums are a lot of money. And most people can't afford the premiums for the amount of money that insurance that they need. And we're going to talk about insurance at the end about how we qualify for this. But I need you guys to understand that there's different ownership ways of how insurance companies are set up. You're either a mutual or a stock ownership company. Does anybody know where a mutual company is? I know you hear the names, but not everybody knows what they are. A mutual company is set up that all the policyholders are the owners of the company. So if you buy your life insurance from a mutual company, when they make a profit, they put the profit back into your policy as a dividend that's yearly. They declare the dividend. So this year, my company declared a 6.98% dividend. They declare it usually in the first week, the last week of the year, or the first week of the year for the upcoming year. Now, that dividend amount is never set in stone. And if they have a really bad year, your dividend amount is going to be lower. But think about it. If they do everything right and they're making money, which insurance companies make a lot of money, you're going to be better off in a mutual company than a stock company, because the stock company, they don't answer to their policyholders. Who do they answer to? Their shareholders. And shareholders, they don't have to have a policy with that company. They're just looking at a rate or a return on investment. Whole life policies. They're usually paid for your entire life. Now, there are newer policies that allow for limited pay times, up to 5, 10, or 20 years. And usually most people pay premiums till they're age 65, age 95, or age 100. Rates are set by each company based on underwriting items of health. I'm sorry, I'm just changing this as I go. And they usually are underwritten based on preferred health status, standard rating, or in some cases, substandard rating if people have health issues. And there is something called waiver of premium, which you can buy in most policies, that in case you get disabled, they will pay for your premiums. And even though your income stream has stopped, they will continue paying the premium. So you'll have a fully paid up policy. So you still get the benefits of that policy for the rest of your life. Now that's an extra charge. Then there's something called universal life policies. What happens is they offer flexibility. They generally have lower premiums. And if you overfund one, not a minimum amount, but a maximum amount, the excess amount goes directly to your cash value. And if you have a high enough rate of return, you may be able to skip some of the payments, or you may stop having to pay early. They also extend to the death benefit. As your money grows in the account, so does your death benefit. Now, some people also find that they may have more death benefit than they need, and they can always reduce that later on, which would also reduce premiums. Let me go down. There's something called variable life insurance. Variable life insurance is very similar, but instead of it going to a general account of the insurance company, they will go to separate accounts that are like mutual funds. The problem is you are taking on market risk now, and you have to meet with somebody who's Series 6, 7, or 63. It's a securities license by the Securities Exchange Commission, and there's more risk involved. So if you're willing to take on more risk, you can get higher rates of return. Variable life insurance is real popular when interest rates are high. When interest rates are low, nobody wants to get involved in variable life because you're taking an additional risk. Okay, let me go to the next type of policy. There's something called variable universal life, which is a combination of universal life and variable life insurance. But the newest product, and this is the one that most people are selling today, it's called Index Universal Life. So what they do is, it's just like universal life, but they tie it to an index like the S&P 500 or the Russell 2000. You're not in the market, but you are following the market. It's sort of like an indexed annuity. So what happens is, if let's say this S&P did 12% this year, they'll figure out the product and they'll go, okay, you'll get a 10% rate of return. There's some cost involved. Your rate of return, there's a really complicated formula, will be 9%. 9% is a very high rate of interest. Here's the good news. Let's say next year it's a really bad year and the S&P loses money. They have a minimum 2% floor in these policies. Even when they lose money, you'll still get a 2% rate of return on that year. So if we look at a traditional stock market 10-year period of time, historically, there's 6 good years, 2 bad years, and 2 mediocre years. The question is, I don't have a crystal ball and tell you which 6 are good, which 2 are bad, and which 2 are mediocre. Well, if that was the case, you're going to get the upside in 6 of them. You'll get 2% in the bad ones, and then you'll get whatever the 4 or 5% rate of return in the other 2. So these are the most popular policies now because premiums are less than whole life. They're flexible and they are kind of tied to the market without actually being in the market, and there's no risk to your principal. So you can understand why a lot of people are buying these policies today. There's something called survivorship life. It's something that this is where my expertise has lied. This is for trust in estates for very wealthy, like pro athletes, who they have a 5 to 10 year window to accumulate all their money for the rest of their life. What's the problem with survivorship? If you're very wealthy, the government will get 55 cents on the dollar when you die if your estate is worth over $5 million. It's called the estate tax or the death tax. Well, you buy a policy on both lives, and when the second one dies, the husband and wife, the second spouse's beneficiaries, the surviving spouse, when they die, they will get all that money, but they're not going to keep that money. They're going to send that money right to the IRS, and they're going to pay the estate tax. This way they can pass their estate tax-free to their full beneficiaries. You guys all know the Cleveland Browns, right? Art Modell was the owner of the Cleveland Browns before they moved to Baltimore. Well, what happened was Art Modell's only source of income was the football team. He had an estate tax problem, and he wanted to leave the team to his kids. But he didn't have enough money to pay the premiums on the insurance policy to do a survivorship plan. He moved to Baltimore because Baltimore paid him over $60 million, which he would in turn put into his estate tax plan in whole life insurance so he could go give the kids the team tax-free without forced to sell. Now, everybody in Cleveland hates him, but they didn't understand his financial situation. I'm almost done. Underwriting of insurance. Basically, you're going to have to, each company's going to have their own actuarial table. They're going to have results of their death claims plus expenses. You're going to have to do a paramedical exam, a physician statement. They're going to do your past medical history, height, weight, medicines. They're going to make a determination to accept or reject you or modify the terms for approval. This process can usually take a month, and all answers on the application are considered to be, your legal verification. And obviously, there's a contestability clause that a company can do if they find out that you misrepresented any material facts on the application. So here's the question we've all been asking all day. So how much do I need? Well, that'd be great if I had the little crystal ball. I knew the day that you might pass and what your family would need that day. But do any of us really know that? No. So the first question is, who's going to be your beneficiary? Your spouse, your kids, a charity, your favorite aunt, your favorite niece, your nephew. And is the coverage for a debt or for a certain period of time? That's when you're going to use term. So how do you find this out? So you want to find out, I use something called human life value. Human life value is that we're going to use an example of a 40-year-old man who is a breadwinner in the household and expects to work another 25 years. He makes $80,000 a year. 80,000 times 25 years would be $2 million. That's not even including any bonuses, raises, or cost of living adjustments that's going to happen over the next 25 years. But he passes unexpectedly. Well, we need to replace his income. We need to pay off debts. And we want to keep the family in the same living status that they did when we met with them. So this amount could be reduced or increased about 10 to 15% either way. How many people can afford $2 million of whole life insurance? Very, very few. So most of us are going to buy a 30-year term policy of $1.5 million. And maybe we'll buy 100,000 permanent life policy. So in 30 years, he's 70, he passed, he doesn't need the term, it's already gone. But that $100,000 on a whole life policy could be worth $400,000 or $500,000 to his beneficiaries. And we put together a plan that was affordable and still held his need while his family was raising his kids, going to college, paying off his cars, paying off any loans, paying off the mortgages. So that's why I use human life value, because it's probably the simplest way to do it. There's other considerations. We have to create a budget of debt, expenses, college funding, child support, final expenses, and mortgage protection. We could do replacement of income, and there is no correct formula. However, insurance companies are not going to give you more than usually 10 to 20 times earnings ever, because that would be over-insuring people, and we don't want to do that. I might give you a disclaimer. If you do desire to purchase individual life insurance, take your time and speak to a South Carolina licensed agent who will do their respective due diligence in setting up a proper plan. Also, I want to tell you, no advice in this presentation is to be used for tax or legal purposes. The information is contained for educational purposes, and there is no solicitation to induce a prospective buyer of insurance in today's presentation. I thank you all for your attendance today. I'm open to some questions after Jim talks about Social Security. And then if you guys want to I'll look in the chat box and I can answer some questions as we go. Thank you, everybody.
David, thank you very, very much. It's that's a great baseline for people. You know, these things, it really is a start point, you know, for teaching things. And before I go into the Social Security, let me just say, are there folks that have some questions? If you want to come off mute and go ahead and ask the questions of David before we lose the, you know, before we move on to something completely different.
Hi, David. I have a question. Is it possible for you to list or type in the chat the name of the website that you mentioned at the beginning?
Yes. I'm going to do it right now.
Thank you.
No problem.
Has anybody else got any questions of David before we roll on to the next thing? Don't be shy.
and listen, let me tell, and this is a lot of information. I gave you probably 30 years of experience in about 15 to 18 minutes. It's way more information than you want to digest. I gave you what I call a product dump. I don't want to do that. Obviously, if anybody ever has any information or questions, you can call me. I'm not going to ever try to sell you life insurance. I'm not a licensed agent right now. I'm just a school teacher. So, but I can certainly navigate you and help navigate you through this process, because most people don't really understand this process, including many agents. They're just ready to sell products. And this is not about product. It's about protecting your family. I have one last thing I want to add. When I went to the $1 Million Roundtable, I met one of the most famous agents in the history of life insurance industry. His name was Tom Spencer. And Tom said, this business is not about selling product. It's about meeting people's needs more of the time, more often, so that when they have a problem, it's taken care of. Because imagine if you sold life insurance and a member of your family died, not your immediate, but even a cousin, and you never had that conversation, and they don't have the money to pay off their bills and they have to change their lifestyle. It's a lot different than going to a funeral when you know that you took care of them. And I usually, if I have a client who had died and I give them a big thing at their funeral, and somebody asks, well, who is that guy? And mommy says to their child, that guy is allowing us to maintain our lifestyle. Then you know what this business is all about.
David, we do have a question in the chat for you.
Okay.
Erica asks, so as a teacher, what do you think about what is offered to us?
Well, you know, each district obviously has their own different plans, but generally most of those plans are group plans that you can make individually when you leave. But the problem is that's the one size fits all, which is like similar to what Elizabeth said. It's really given me a lot to think about outside of what Dave Ramsey recommends. I know I've read all of Dave's stuff. Dave says some really wonderful things. However, I have some problems, and Jim and I had this conversation the other day. The company that I'm with, Dave is with too, and Dave in his book tells buy term and invest the difference to people. And he has like kind of a one size fits all mentality. First of all, that's never the right thing to do because everybody's different. We all shouldn't be lumped in the same. Number two, I know for a fact because the company that my insurance is with, Dave also owns whole life policies, which he does not disclose in his book. And he tells you to go call up the 800 number in his book, and he does not disclose again that he owns that company. And I don't think that's very forthright of Dave Ramsey. And I'm not picking on him because I don't think that's really right. I don't think one size fits all for everyone. No financial product does that.
On that note, and that's certainly an interesting note, let me just, and if you do have other questions on this as we roll along, feel free to just put it in the chat because you never know when something pops up in your head. Just put it in your chat. I simply asked, I've kind of been doing this stuff in more of a supervisory role for almost 10 years, and I was amazed at how many people I talked to, because I'm getting up in that age now where we should have talked about it, and I'm just amazed at how many people have not talked about Social Security. And the number of young people that I run into, including my own kids, early on, who say they don't think Social Security is going to be there, and in a way that's healthy enough. That means you got to save a lot more, right? But in the end, Social Security will always be there. Okay, you can't have the kind of a social contract where somebody pays into Social Security over the course of their life and then just say, oh, we're going to turn it off, quote, we're out of money. I mean, that just doesn't work. There's no big pot of money in Social Security anyway. And when they talk about it's going to run out in the year 2035 or whatever, what you're really saying is the amount of money that's coming in, that's coming in will not be as much as needed, the expectation for what is going to be going out. But there's not a big pool of money, okay? I mean, so in the end, Social Security, they have a bunch of ways to fix it, and they're already doing it, and very few people even notice. They change they move your, what do you call it? Now I've lost the term. You've got your, the value that your age, your Social Security, your full retirement age. And that term, the full retirement age, that's different than 62 years old. We all know what 62 is. Okay, that's when you can draw Social Security if you elect to. But your full retirement age is a point where the government has said, well, this is the point under the following circumstances that you can draw your money and we won't take anything back, okay? So your full retirement age, in my case, for instance, I could have started Social Security at 62, but my full retirement age is 66 years and 4 months. Almost everybody on this workshop it's going to be farther out than that because you're younger than I am. Okay, so and they can adjust Social Security by taxing people more. You can say, hey, people, we're going to raise taxes, Social Security taxes, on people who make more money. Well, that's an option. And oh, by the way, that's kind of been going on a while too. You can reduce the amount of money that you get as you grow when you get Social Security. So there's a lot of ways to reduce and to adjust in Social Security, but I can assure you it is not going away. All right, so you can plan for it. Now, exactly what you're planning for is kind of hard to say. Social Security has always, or historically, has been a stool concept. And the stool concept, when developed in 30 years ago, in the 1930s, the stool has 3 legs on it. One of them is Social Security. The other one is your pension. And the other one is your savings. Okay, now there are other things you can add to make it an even nicer stool. You know, you can, your investments though include all kinds of things, your stock investments, your, you know, what you put in your home, the value, what you, real estate, the diamonds you collect, whatever it is. But Social Security was never intended to be anything more than to keep you out of abject poverty. Okay. But a lot of people think, oh, I can retire on Social Security. Folks, it's not true. You know, I mean, you can retire on it, but you know what you're more than likely going to do is your standard of living is going to drop down to the floor. And you're going to have your kids move close by so that they can help take care of you. And you're just going to hope that you don't have a big medical problem. But in the end, Social Security is not, is not going to be a get out of jail card. Now, I will say for the very lower income, Social Security, you know, you've probably already gotten used to not having a high standard of living. And so maybe it's not quite as difficult, you know, to learn to how to have a lesser standard of living than to begin with. But again, it's not going away. Okay. There's another thing that is important, and that is every year when you turn 62, and everybody needs to go onto the government website, you know, just .gov, socialsecurity.gov, I think. Go in there, sign up, and they'll show you exactly how much you could get if you went on Social Security today. Now, for a lot of you, you're younger, they'll show you that, well, you've still got a long way to go before you can get Social Security, but here's what'll happen in 10 years when you turn 62. But they'll tell you exactly what you got. You've got to have 35 years of income in order to draw Social Security. Now, that may be 30 years with zero at 5 of them, okay? But in the end, you've kind of got, they're going to take the top 35 years of your earning years, and that's where they draw their calculations from. So if you get to 35 and you're still making a whole lot of money, well, then they're going to drop the lowest ones, okay? Now, don't worry about they adjust for the cost of living. So when I was making my first year rate, I think, you know, $9,000 a year, that one is quite a bit different now because they add a cost of living. And, you know, but in the end, they're going to take the top 35 earning years, and that's where they're going to draw, you know, they're going to come up with their calculation for Social Security. Okay, so one, it's going to be there. Two, well, whatever I said. Okay, now the next piece is, again, if you can start at 62, then you can draw Social Security if you want to, but then you get to your full retirement age, which might be in the late 60s. And if you draw Social Security and then and you sign up for it and you start getting money, and then you start earning money because it's like, hey, I want to get my Social Security, but now you start earning money. They're going to take $2 out of the $3. They're going to take it back from you, okay? Because you don't get Social Security when you said you've retired and then you're going out to work. This is not a freebie. This was to help you at the point in time when you were going to retire. So, but once you get to your full retirement age in your in your later 60s, then you can keep all the money that you earn and you can keep Social Security. Okay, so you make Social Security, but don't be working. Okay, or then you get to the full retirement age, then you can work all you want and keep the money. And then when you get to 70 years old, there's no more increases to Social Security other than a cost of living increase. So you may as well draw Social Security because it doesn't do you any benefit for not drawing it, okay? So although every year from 62 to 70, you'll get 8% more every year. How many of you get an 8% raise in your income every year? Most of you don't, okay? So generally speaking, and I'll show there's reasons why you wouldn't, but generally speaking, hang on, don't apply for Social Security at 62. Wait at least until you get to your full retirement age. And now you can keep on working if you want, and you can keep drawing Social Security. But you're missing out on some 8% raises up until 70. But by 70, hey, go ahead and work, draw your Social Security, do all that other stuff. There are some times when you might want to draw Social Security earlier. For instance, if your health is concerned, or you lost your job and you don't have a way to make it, well then go ahead and draw Social Security. But just know that there are costs associated with it. But plan for these things. Don't plan for, don't just plan cold at 62, I'm going to Social Security and I'm out of here, okay? At least consider going to your full retirement age and then saying, I'm out of here, right? Or ideally, look, we all live longer, so, consider going to 70 before you do. Now, I'm just saying those are options for you. Anyway, so those are some kind of important things. And I think I covered, I've got a little cheat sheet that you can have that actually, I say 10 or so things everybody should know about Social Security. I've kind of covered most of them. And so take a look at that. Also, you will get taxed. Your Social Security that you get will be taxed, but it will be taxed. There'll be a certain amount of it that won't be taxed. And the amount of it that you won't be taxed, and you'll be at a very low, the thought is you're going to be at a much lower tax bracket. And so, you're really not going to be taxed very much. Now, if you're a millionaire and you're drawing Social Security, well, they're going to tax you a little bit more than they would have if you, making 30 grand a year. So, but in the end, there is a benefit once they start, an amount that you don't pay taxes on when you get Social Security. Let's see. And remember that Social Security is forever. Once you start taking it, you can take it for the rest of your life. There are a couple of ways you can say, I've started Social Security, oops, I made a really bad mistake, and there's some ways you can kind of go back. I'm not going to get into the what ifs because I'm not an expert. I just know some basics because, I've learned them myself because I've had to go through it. And I'm amazed that nobody seems to care about it until they get up in their 60s. So, get yourself mentally prepared so that you don't jump on that 62-year-old I'm out of here bandwagon, unless you at least know what you're doing. And I think that was most of it. Does anybody have any questions about Social Security? Or we can go back to David and ask those. I see a hand up for Darren. Go ahead. Or no, I guess not. Anybody got any basic Social Security questions? Okay, well, that's perfectly fine with us. Amanda will she will have both the slides available to you as well as my little one pager with my 10 or 11 or so thoughts on Social Security, which are available to you. I'm a big believer in self-learning, that Google is your friend. Go in, Google it. Now, I'm not saying that thing is perfect because usually the ones that are at the top of the Google are, those are companies that have paid to be at the top of Google. But in the end, they're generally not all lies either. So, scroll on down, find a couple of questions, ask them. And they're, I found Google to be a pretty doggone useful resource. I don't ask the social media network. Of course, I avoid most social media networks anyway. But okay, I guess I will turn it over to Dave. I'll turn it back over to you if nobody has any questions, and then we'll turn it back over to Amanda.
I just want to thank everybody for coming, and we're going to turn it to Amanda because I know we have our evaluation and we have a way to make some money. I'll let Amanda talk about that.
Jim, I have a quick question.
Okay.
What happens if you're a single and you die before you reach the age where you can apply for your Social Security? What happens to those funds?
All those funds, unless you have dependent children or dependent family members, those funds just go away. They go back to the government. They never get distributed. Okay, did that answer the question?
Yeah.
All right. It's kind of like term insurance. once the term is over, you don't get anything after that. Okay. All right. So back to David.
I'm good. I'm going to turn it back to Amanda unless anybody has another
Okay. Sorry.
question.
Back to Amanda.
No, that's totally fine. Well, David and Jim, thank you so much for all of the information about insurance and Social Security and all of the things that we have to look forward to as we grow older. David, can I ask you to stop screen sharing? I'd like to show our participants some of the websites. As you guys probably noticed, I dropped into the chat box to stay tuned for 2 announcements. One of those is the evaluation for tonight's session. That is the link that I have already put in the chat box, the Google form. For those of you who have participated before, this should not be anything new to you. But just as a general announcement, we have also an incentive for attending 5 of our webinars in the spring. So for those of you who have attended tonight, you have checked off the box for the first one. And what we do, just so that you guys know, we generally wait until the webinar series has come to a conclusion before we cut those checks, just so that everyone knows not to be expecting your checks until the end of our spring sessions. But we do thank you guys. I hope that you learn a lot from what is presented tonight. I am going to just really quickly share my screen with you guys so that y'all can see just a couple of things that we wanted to share out with you. So the website for David's program, and many of you who are listed in this webinar tonight, the South Carolina Financial Literacy Master Teacher Program is a wonderful opportunity for teachers to not only gain further professional development opportunities in financial literacy and economics, but this program, which is sponsored by our state treasurer's program, also allows teachers like David the opportunity to share with others so that we can all grow professionally. And David and our other master teachers are incentivized to do that. So with everything, there is an incentive to do it. And you guys can check that out further on this website, but I just wanted to show y'all a couple of things. This is really simple, scflmt.org. It stands for the South Carolina Financial Literacy Master Teacher Program. So the home screen obviously gives you some information about it. If you are not one of the master teachers, we are certainly happy to accept applications for year 4. We're going to roll into year 4 in the next school year, which is pretty amazing. And then you have obviously some requirements so you can learn more about the program. For those of you who would be entering the first segment, this is what we call the bronze level. Get your feet wet. Conduct one professional development that is 1 hour. It can be in person, it can be on Zoom, it can be something like this, or it can be with people at your school or in your district. The big thing is we want for you guys to share the great news of financial literacy and economics with other teachers, because we know that great teachers and good financial education instruction will trickle down to those students and continue to help our students and young people be more prepared to be financially responsible in the future. So on this website, again, you can apply for the next cohort. If you have any questions about this, please feel free to reach out to either me or Chandler about it. This is the 4th year going into this program, so we kind of have all of the jiggles out of it. And you can also see some of the opportunities for the honorarium. So what you'll get paid, what are the financial incentives to do this? And then the last thing I wanted to share with y'all, this is really tip number 2. For those of you who are participating in the workshop tonight, we have a financial incentive for you as well. So you don't have to necessarily be a financial literacy master teacher to be incentivized further. We want for you to share the good news with students in your classrooms. So if you learned something tonight that you feel that you can share with your students in a class, we encourage you to be able to conduct a financial literacy lesson based off of the insurance and Social Security information. Again, as Jim and David mentioned, I will share out the PowerPoint and Jim's 10 tips as well in the follow-up email that I'll send to each of you. If you teach a financial literacy lesson based on this, and then follow up with this teacher participation form, then we will evaluate these and you'll have the opportunity to earn $100. So just to give you guys kind of a glimpse of how you do this, it's not it's not just a really simple thing to fill out like your evaluation. It is a little bit more in depth. So you'll have to show that you have actually taught the lesson to your students. So take pictures during the lessons, provide samples of student work. What are your learning objectives? Maybe, the PowerPoint that you used. Certainly David's would be a great one to use, or if you want to make it your own, that's also totally fine. But this is again one of the initiatives of the treasurer. He wants for us to not only spread his great news of financial literacy through South Carolina through you guys as master teachers, but for the teachers who attend your sessions to be able to follow up with their students as well. So as you guys requested, I'm going to drop 2 of those links in the chat box for you. This is the general information site for the South Carolina Financial Literacy Master Teacher Program. And then we have also placed that teacher participation stipend or teacher participation form for the stipend on that website as well. So those 2 links are there for you. And then I'll go ahead and stop sharing. If you guys have any further questions about that, I am happy to answer them. We have a lot of thank yous. Please be sure to fill out your evaluation, the first form that I inserted in the chat box. That's our key to making sure that you guys get paid if you're in the running for the incentive. But if not, I hope you guys, all of you, learned much from Jim and David tonight. Feel free to stay on if you have any further questions. If not, we'll see you at the next one.